Is it coincidence that after all those months of silver deliveries that Trump called it a critical mineral and Project Vault to have a government-backed accumulation program and price floors government-backed in order to incentivize domestic mining and refining? I can keep going on, but the point is simply this. Price is simply a tool of misdirection, and when the most well-funded and well-informed traders on the globe are prioritizing physical possession, look at France. What did they do? They just brought all their gold back, but that followed Bundesbank, the Dutch National Bank, Bank of Hungary, Turkey, Poland, Bank of Austria, all of these banks, the Czech National Bank, they all brought their gold back from the Bank of England and the New York Fed, which was great convenience, added great liquidity to their gold holdings because you can sell it in a second on the LBMA or on the COMEX. But you know what? They'd say, yeah, I think I'll prefer holding it myself and at the expense of a little bit of convenience. It all boils down to trust.
So, Andy, it's been quite the trip here with the precious metals world. At the time of recording, the price of gold and silver are down substantially today. But by the time this gets published, they may be higher than they were a week ago. Who knows with all the volatility? So, Andy, you follow this as closely as anyone I know. What's going through your head right now?
That price is a tool of misdirection. That the biggest money in the world uses price on many levels to misdirect anywhere from the public to large institutions to the true value behind gold and silver. I'll give you an example. First of all, the price collapsed in the end of January, and the Bank of International Settlements came out and they said, look, this was not a fundamental correction whatsoever. This was structural. This was all orchestrated, if you will, at the hands of the CME group, the COMEX. Two things happened. Every January, you see ETFs that need to be rebalanced as part of the protocol in their prospectus that say, there has to be a certain level of balance. So typically the first and second week of January is notorious for this rebalancing, where things that have gotten out of whack after, months and months of silver going up unabated into the end of the year, it was those relationships were way out of whack. So they had to rebalance, meaning sell a whole bunch of silver to get those ETFs back in line. At the same time, the CME group, in their infinite wisdom, raised margin requirements by 300% from the beginning of December till, the midpoint in January when things finally collapsed. And when the BIS came out and wrote this report, to me, knowing what I know, made it almost sound like they were saying, why would you guys do this? Of all times to raise margins to this degree, in the face of rebalancing effects the first and second week of January, you were all but guaranteeing a massive washout where the speculative froth would be literally kneecapped. And that's what happened as margin requirements went higher and higher and higher, which made people sell. They couldn't carry the margin requirements. It was $15,000 approximately to hedge 5,000 ounces of silver December 1st. By 6 weeks later, it was 54,000. And so, if you have a contract that all you needed to do on December 1st was post 15,000 in margin in your margin account, just sitting there as collateral, 6 weeks later, that number had to be increased to 54,000, or they margin call you or close out your position. What if you had a dozen or 24 of these contracts or 50 contracts and enough margin in there? You're talking serious money. Or you're a company like mine that has 2 million ounces of silver that we hedge ounce for ounce. You have to have $50 million just sitting around in a margin account just to hedge that exposure for silver, let alone gold and platinum and palladium. So it created a synthetic orchestrated event that just kneecapped the price. But I call it the Shanghai flip. A lot of people in the industry are as well, where if we look at the numbers in January and February and March, let's keep in mind that, China is the second largest producer of silver in the world. And as the price was getting destroyed, China imported the most silver ever 2 months in a row in February and March. Their imports rose 78% month over month to a record 836 tons in March. That's 173% above the 10-year seasonal average for March. Year-to-date imports are up to almost 1,700 tons, the highest on record. And this is in the midst of silver getting destroyed. And the same thing is true for gold. Their demand for gold, I would argue, is reaccelerating. Their gold imports rose to almost 170 tons in March, the highest since March of 24. This marks the third consecutive monthly increase. It marks a 17th consecutive monthly purchase. They're still stockpiling gold. And when you look at what's happening on COMEX, February is another good example. So the price got destroyed in February, right? What did we see in February on COMEX? We saw about 26 million ounces get delivered. Now that follows a pattern we've seen going back for over 18 months. Since last November when he won the election, every single month we're seeing deliveries that no one's ever seen before. Never. Every single month, billions and billions and billions and billions and billions are being delivered. However, you get 26 million ounces delivered at, call it $70 an ounce, it's $1.5 billion, but 39 million ounces walked out the COMEX that month, left the ecosystem, never to come back. They would have to be drilled and filled in order to get back into the ecosystem. That's 2 million pounds of silver. Who in God's green earth is running logistics and insurance to take 2 million pounds of silver on semi-trucks and drive them through Manhattan to wherever they're going? That's a question that needs to be asked. Could it be the U.S. government, now that silver is a critical mineral? Could they be the ones that are importing every month gold and silver to the tune of billions and billions of both gold and silver every single month since Trump won the election? And this is the one thing that the public or that the media completely has missed. I don't care about the price. It's a tool of misdirection. I don't care about what they think is the reason. They want to tell us that the reason gold fell off after the war started is because, well, you're going to get higher inflation due to the CPI rise with oil, and therefore the Fed can't be dovish. They're not going to be able to lower rates. Who cares? Go back to 2019 when gold was $1,800 an ounce and the federal funds rate was zero. We watched it move up 450 basis points, the most ever in a one-year period. And what happened to gold? It's now tripled. It's an environment where we are supposed to believe that the Fed has to lower rates to make gold go higher. I would argue this. Why this time? This is the first war. I've been doing this for 36 years. In every single Gulf War or anything in the Middle East, we saw a pattern that was very recognizable. We'd see assets sell off, including gold, throw out the baby with the bathwater. Now, I always felt that was mope, as Jim Sinclair, my dear departed friend, used to say, management of perception economics. But let's just say it will follow the mainstream's thinking. Everything gets sold off, from equities to commodities, to come up with cash. There needs to be a rush to liquidity. The dollar gets a massive bump as everyone is buying dollars because oil is priced in dollars. Oil is going higher. The dollar starts to go higher. More countries need to sell more of their currency to buy more dollars. Assets sell off. Currencies sell off. The dollar gets a bump. Oil gets a bump, but the one thing that we always have seen every single time is interest rates would fall. Why? Because everyone's rushing to the safety of treasuries. Well, what happened this time? No rushing to the safety of an asset that can be confiscated and sanctioned like the Russians taken. Instead, rates rose because we saw selling of treasuries. Now, some would say, well, they were selling treasuries to get dollars. I say not true. I say that they look at gold as a better proxy for a reserve asset than they do U.S. Treasuries. No counterparty risk. It's doubled the performance gold has of the 10-year Treasury for 25 years. And look at the last 2 years. It's 10x'd it without the risk. And so when we talk about the mainstream media, they want us to believe that just because the Fed can't accommodate by lowering rates, which, again, rates should be calculated by the market, not by the Fed. But just because they can't be dovish, well, gold's going to sell off. BS, number one. And number two, bigger BS is, why is there no journalistic integrity asking who the hell has been standing for delivery for 18, 19 straight months to the tune of billions and billions and billions and billions and billions and billions every month? Where are they? Why don't they ask that question? It's the only question that matters. Why? You're from Canada. They would always ask, you know hockey, right? Why they'd ask Wayne Gretzky, little guy, how the hell were you so good, Wayne? Because I always skated to where the puck was going, never where the puck was. Well, do you think these people who are the most well-informed, let alone the most well-funded traders on the planet, are dumping billions every month for going on 2 years just for the hell of it? Or do they know where the puck is going? Is it coincidence that after all those months of silver deliveries that Trump called it a critical mineral and Project Vault to have a government-backed accumulation program and price floors government-backed in order to incentivize domestic mining and refining? I can keep going on, but the point is simply this. Price is simply a tool of misdirection, and when the most well-funded and well-informed traders on the globe are prioritizing physical possession, look at France. What did they do? They just brought all their gold back, but that followed Bundesbank, the Dutch National Bank, Bank of Hungary, Turkey, Poland, Bank of Austria, all of these banks, the Czech National Bank, they all brought their gold back from the Bank of England and the New York Fed, which was great convenience, added great liquidity to their gold holdings because you can sell it in a second on the LBMA or on the COMEX. But you know what? They'd say, yeah, I think I'll prefer holding it myself and at the expense of a little bit of convenience. It all boils down to trust. People don't trust the Treasury market. They don't trust our geopolitical and political motivations. They don't trust our anything these days, and that's including our exchanges. And that's why you are seeing removal of metal quietly, not too fast to cut off your nose to spite your face, but slow enough, slowly draining so as to maximize what they can offtake, because if they try to do it all at once, they would get cash settled force majeure and the whole thing blows up. But every month we're seeing the same thing, and it is being missed completely and totally by the mainstream, and that's really, to me, all that matters.